So we're heading into budget 2020, and there's a lot of expectation in terms of what the government is going to announce, and how are things going to play out as we head into that. It's an interesting kind of a budget. All budgets are interesting, but this one assumes an interesting proportion purely because of the fact that we are in the middle of a slowdown or slowing of GDP growth, and we are looking at some sort of fillip from the government to be able to take this situation in control, and be able to kind of do some spending around that. So there's a keen observation in terms of what's possibly going to happen in this budget. Obviously, from capital markets perspective, budgets assume more importance because trades are riding on it, and so consequently there are already some set of expectations that capital market participants have built in. The government obviously has a job to kind of balance what's happening in capital markets, what's happening in actual markets. So the government will have to take a look at all those areas as well, right? Uh, let's quickly look at previous budget estimates first. Then we will broadly look at what's the key issues that the government is facing at this point of time. And then we will move on to expectations from the budget, right? So broadly speaking, if you were to kind of look at what's playing out in terms of the previous budget estimates, it'll give us a good indication on what's possibly going to follow. So we have to take a step back and understand what's happened in the previous few months and how that has played out. Now, this budget of 2020-21, financial year 2021, that's coming in 2020, uh, is going to be a sort of a toss up between growth and fiscal prudence. The government has to basically take care of what their revenue versus expenditure scenario is, and you don't necessarily want to spend much more than what you are earning. And that's been the sort of effort of government of India for a while now, to keep fiscal deficit in control. But at the same time, given the impending slowdown, the slowdown that's continuing, the government has to basically also focus on growth measures. Now, does the government have enough room to focus on those? Does the government have enough room to kind of go ahead on an expansionary phase? So these two objectives are broadly at loggerheads with each other. If the government has to focus on growth, then the budget has to be expansionary in nature. If the budget is expansionary in nature, fiscal prudence will take a back seat, and you will have larger fiscal deficits that are going to come out. So that's something that the government has to take a call on, in terms of whether they will go ahead and say, okay, we'll leave fiscal deficit aside for some time and we'll focus completely on growth. Or if the government says that no, we can't really leave fiscal deficit aside because the entire world is watching us, and most of the flows into India from foreign investors depend on what we do with fiscal policy. So we can't really go down that path as well. Uh, if you are looking at a focus on growth, then the government has to boost infra spending. It has to boost real estate sector. Probably has to do some sort of tax reductions, income tax, GST. Although GST doesn't come under the purview of the budget now, it will be taken care by the GST Council. But if you're focusing on growth, then you are looking at an expansionary scenario, more expenditure, and give cuts as much as possible on the tax front. If you're looking at a fiscal prudence scenario, then you have to reduce sort of expenditure. You have to widen the tax net, and you have to focus a lot more on privatization, which of late the government has kind of started doing, in terms of the Air India and BPCL privatization calls that have been coming up. But that's basically a toss up between these two, and it remains to be seen where does the government focus more on, because without a significant expansionary policy, it's going to be difficult for the government to create jobs. Without jobs, sustainable growth doesn't come in, and that creates a challenge. So will the government take hard steps that are going to focus on growth in the long run and work around those, or will the government kind of stick to its fiscal prudence and say increase tax revenues, reduce expenditure, and let the market take care of itself in terms of the slowdown? That remains to be seen. It seems a tricky kind of a choice for the government as they kind of head into this. So the first problem that we are facing at this point of time is a massive tax shortfall. So in terms of our overall sort of numbers that we had projected. Last year, we had set ourselves an ambitious tax target. Now we are far from achieving it, and we are seeing a growth rate at center's tax revenue growth rate at 2.6%, which is the worst since almost a decade now, right? If you look at this growth rate in the center's net tax revenue, not the gross tax revenue, the net tax revenue, this is one of the lowest growth rates, obviously driven by some sort of a slowdown. There was some issue that kind of cropped up. We had, post this point, we had demonetization, GST, etc. coming in. But specifically with respect to the latest, sort of GDP slowdown and the economic slowdown, auto sector reeling, some of the other sectors also fearing the brunt, NBFC is not doing too well, banking credit growth slowing down, it has seemingly had a clear impact on the corporate growth rate and consequently a seeming impact at the net tax revenue growth rate. There are other factors as well. So what are those factors? Let's try and gauge those as well. Uh, if you look at broadly the collection numbers, so from the previous year's provisional accounts, what was the actual provisional estimate of last year? The growth rate that was expected in corporate tax was 15%, income tax, direct tax was 23%, customs was 20%, and GST was 44%. What you see in red is the actual growth till November 2019. So year to date, the growth rate has been very slow. Obviously, in certain cases like corporate tax, this has been driven by the tax cuts that were announced. And that was kind of known when the government had announced the tax cuts that this is going to have an impact. And so that's something that has played out. And consequently, that's created a sort of a task for the government in terms of how do you go about looking at this entire picture. Now there are some numbers in terms of what the budget estimates for 2019-20 were and what is the actual number between April to November at this point of time. These are taken off RBI's website, and if you look at some numbers, there are some interesting points. Now, the ones in red are the ones where the achievement is significantly below what is the key number there in terms of the estimate, right? So tax revenue in the first 8 months is only 45% of the total target. 16.5 lakh crore was the target, right? And we have had 7.5 lakh crore so far. Now, obviously, tax revenue is back-ended, which means the last 4 months account for a lot of it in the year. But till last year, this number used to be about 50%. We are already short by about 4 to 5%, right, in terms of year-to-date achievement there. The second problem we are facing is this other receipts, which was the disinvestment target of the government, which is about 1 lakh 5,000 crore. So far, we have done about close to about 18,000 crore till November. A little bit has happened after that, but till November, this is done. So unless something goes through in the next couple of months, it's highly unlikely we are meeting this target as well. On the other hand, most of the expenditure items around revenue and capital expenditure have basically been around 65 to 63 kind of percentage points, which means that's basically at the pace to meet its target during the year. So the government ends up facing some sort of a challenge at this point of time in terms of how do you make up for the numbers that are getting lost. If you look at broad estimates in terms of the corporate tax collections, so if you look at the actual estimate in FY18, that was the number. Then last year budget said 671. The provisional number came at 663, right? This is direct taxes basically. The provisional number came at 663 for corporate tax, and the expected growth rate was 15%. Based on that expected growth rate, we had projected the estimates for this year, and this is what is falling short at this point of time, the corporate tax as well as direct tax collections. In fact, in direct tax, the growth expected was 21%, and that's been under some sort of a stress as we see it at this point of time. So part of this shortfall was kind of expected when the government announced that that this would happen. They had done a back calculation, and that back calculation basically said that out of this 7,60,000 crore, there would be a total revenue loss of 1.45 lakh crore to the government. So approximately 1.45 to 1.5 lakh crore was the shortfall that the government had already projected in September, October, uh, after this corporate tax cut was announced, basically. And that shortfall obviously has to be made up by other segments, but the other segments are also not doing well. So even in terms of direct tax collections, etc., there is a little bit of a challenge, right? So now let's look at the budget versus actual numbers at this point of time, and then look at what kind of estimates we feel are possibly going to happen for 2020, right? So when we had the budget estimates, just a quick recap of the total numbers of India. This 16.5 lakh crore is the tax revenue net to the center, right? Total tax revenue uh, is approximately about 24 lakh crore, right? India's GDP is approximately about approximately about 2 crore is the number. This is an estimate. This was an estimate based on last year GDP number, and the government had assumed about an 11.5% growth in nominal GDP growth. Now we know that 11.5% has not happened. The growth rate has been about 8%. So that will result in the actual GDP, nominal GDP number, at about 2 crore. We are probably going to see a total tax collection of about 23 to 24 lakh crore broadly on that in this year, right? The same year to date numbers are kind of available here in terms of what is the percentage achieved. You look at 16.5 lakh crore of total net tax revenue. There's some sort of non-tax revenue where all your RBI dividend etc. come here, right? So this has already achieved 74% of the yearly target till November, and expected to kind of go up because the government there's more talk that how will the government make up for the shortfall there. So that's likely to happen. In terms of capital receipt, disinvestment was at about 1 lakh crore was target. So far 18,000 crore till November. In terms of expenditure, there are two components. There's a capital expenditure term, which is basically anything that is in infra or something that is to do with adding assets to the government. That's capital expenditure. Everything else, which includes subsidies, salaries, pensions, interest payments, goes under the revenue expenditure. Revenue expenditure obviously is the larger component of total expenditure of Government of India. These were the estimates: 24 lakh crore and about 3 lakh crore, giving about 27 to 28 lakh crore of total expenses. Uh, Revenue would be 19 lakh crore here, plus about close to about 1.2 lakh crore here, adding these two. So the shortfall was about 7 lakh crore. The expectation of the shortfall was about 3.35%. This is getting rounded off at a broad level. Right now, what happened beyond that is there seems to be a shortfall in terms of the tax collection. Now, this shortfall is on account of both direct and indirect taxes. Nearly 1.5 lakh crore is the shortfall on account of corporate tax. There's a reasonable shortfall in terms of about 50 to 60,000 crore that's happening on account of income tax, and remaining shortfall on a gross level on account of GST as well. So all these put together basically put a total net shortfall of nearly 2 lakh crore. Part of that is being made up by the extra dividends, etc., that are happening to the government this year. So instead of 3 lakh crore, we are going to probably see an income of 4 lakh crore here. We've just, for simplistic assumptions, converted all these into $1 billion at 1 USD equal to 70 INR, right? Just for a simple calculation purpose. So just multiplied the numbers, so USD conversion to INR at 70 to get $1 billion numbers as well, right? Because there is a shortfall here, and it's highly unlikely that we will even reach this 75,000 crore, because only 2 months are left, and it is unlikely that any of these stake sales are going to go through. The market is not really too enthusiastic about all the sort of PSU stake sale, and that's basically where the challenge lies. Now, in order to keep fiscal deficit within 4% of GDP, which the government is likely to come and announce, what is also going to happen is the expenditure. The major chunk of the expenditure is revenue expenditure. That is going to be curtailed, most likely, right? And in the last 2 months, it's likely that the government will pull back a little bit in terms of the remaining expenditure that needs to be done so that the fiscal deficit number does not completely go out of whack, right? So that's something that is likely to happen. Obviously, that has ramifications because if the government doesn't spend, then all the rural schemes, etc., come under this. So if the government doesn't spend the actual amount, there is going to be a little bit of a challenge. So the government is actually caught between sort of devil and the deep sea, right? How much shortfall? You have a massive tax shortfall, so it's likely that all the ministries that have not spent the major amount so far, right? So there are certain ministries who have spent anywhere around 58% or 60% of the total, or even lesser, like 49% here, Ministry of Agri and Farmers Welfare. It's likely that they are going to not spend more because you see last year they had already spent like 70% till now, right? So it's possible that the government is going to pull back a little bit on the spending in the next couple of months, only to ensure that the fiscal deficit does not go through the roof, at least in the near term. Right now, is that a correct strategy, not a correct strategy? Obviously, we'll have to debate. As I said, if the government continues spending here, if the expenditure goes up or remains where it is, then fiscal deficit has to go up. If fiscal deficit goes up, then borrowings have to go up. If borrowings go up, that in turn takes interest rates higher, right? So that is where I think the monetary and fiscal policy again kind of collide, where if the government doesn't have a fiscal expansionary room and they keep borrowing in that context, it automatically takes interest rates higher because the government crowds out the other borrowers. And if interest rates keep going higher, then there's no impact of the monetary policy that RBI is having all this while, right? So that again, I think creates a little bit of a challenge for the government. So now what are the possibilities that could play out, right? Now, there's one more issue here is that this actually does not represent the correct number. What the government also ends up doing, and I think that's something that is now in public domain, so it's important for the government to curb it or at least give clear roadmap around what's going to happen, is that the government does something called as the IEBR, right, which is internal and extra budgetary resources. Now, what it says is the true fiscal deficit could be as high as 5.5% in financial year 2020 if you were to take into consideration the estimated off budget liabilities. Now, what are these off budget liabilities? Typically, the government has to give a subsidy, for example, food subsidy to Food Corporation of India. Instead of giving a subsidy, the government as essentially tells Food Corporation of India, please go and borrow this money, and we will give you this subsidy over a period of time. So what the government is basically doing is amortizing the subsidy. They are amortizing the subsidy over a longer period. That is not helpful because they've been doing it for the last few years. And what's happened is if you look at the subsidy deferred during the year and the total carryover liability to FCI, Food Corporation of India, the number used to be about 50,000 crore here. That's gone north of 2 lakh crore because every year there's a shortfall of about 50, 60,000 crore, which is given out as loans, which FCI borrows. Now, this technically is the same as the government borrowing because the government is backing FCI, right? But in the truest sense, it doesn't come on the balance sheet of the government because the government has not gone and borrowed this money. Food Corporation has borrowed this money. So it appears on the balance sheet of Food Corporation of India. You see this? This is about 94,000 crore. Last year was 56,000 crore. There's a change of about 38,000 crore here. And there's a change of nearly about 25,000 crore here in long-term and short-term borrowings. This roughly about 65,000 crore of borrowing is against the deficit that was happening in 2018. Same has happened in 2019 and the same is happening in 2020 as well, right? So where does this money come from? FCI borrows from the National Small Savings Fund, right? So NSSF gives the money. The government says NSSF obviously has long-term money, so they're going to return it at a later point of time. The government says we are going to give you this money, which you can then repay the NSSF at some point of time. And for example, if there is 70,000 crore that the FCI has borrowed from NSSF, the government says we'll give you 14,000 each year as food subsidy. So instead of giving 70,000 as food subsidy in the first year, the government has basically amortized this over the next 5 years. 70,000 crore of loan does not come on the government's book, it comes on FCI's book. But this is actually government borrowing, right? So the market knows about it because this is in public domain. You can go and look at the FCI annual report. You can read about, uh, extra budgetary resources that are being used. The same also plays out with players like NHAI. So instead of the government spending money on capital expenditure, it is the NHAI which is asked to kind of borrow money and use that. So again, those liabilities are large and effectively are government liabilities, but they don't get represented here. So if you actually look at this number balloons up significantly. If you add this is nearly 2 percentage points. So we're looking at 5 to 5.5 percentage points as such. And then there is a state fiscal deficit that comes in. That's another 3% of GDP. This is only central government, remember, right? 5.5%. Then you add the state government, that's about 3%. So that goes up to about 8.5% of total gross fiscal deficit on the government level, both union and state governments put together. And all this is going to come through borrowing. So state governments and union government are the largest borrowers, and they have basically cornered a lot of the borrowing markets in India. So that creates a little bit of a challenge in the landscape that remains in terms of the fiscal room, right? So that's where we are in terms of these numbers. The other problem we face is this entire job slowdown. Now, because there is a slowdown, uh, it's probably a sort of, some people say it's a cyclical slowdown, some people say it's a structural slowdown, but we are in the middle of a bigger slowdown than what we had anticipated. GDP growth estimates at the beginning of the year for FY20 were approximately around 7%. Within the first 7-8 months, they've been scaled down to 5%. This is, of course, real GDP growth numbers, but nominal growth numbers are also expected to be 7, 8, 6, 7, 8%, somewhere around that, right? Depending on what inflation we look at. So there's a slowdown, there's sort of automation happening, lesser job creation, exports are not growing at the rate we would want to. And last year, as per the EPFO data, we had created about 90 lakh new payrolls. This year, we are creating nearly 16 lakh lesser, about 75, 74 lakh jobs. Now, that obviously creates a problem because this feeds into lower tax, this feeds into lower sort of consumer spending. And so there's a demand side issue there as well, right? That comes up because of this. So unless you kind of create a jobs supply somehow, there is going to be a challenge, sooner or later. You could defer the problem by probably throwing some money at the problem today, but it's not going to take the problem away. So that remains a challenge at this point of time as we look at it in terms of what we would expect the entire sort of uh, uh, plan of action that the government has to take in this particular budget. So we have to closely observe this as to how they go and talk about job creation. Some of the things that you would anticipate or expect would be that there should be a lot of focus on MSMEs and startups, because these are the segments which are kind of creating jobs. They've given a corporate tax cut, basically trying to kind of spur this investment demand. But the problem in a slowing economy or an economy that is growing at a slower growth rate is that most corporate tax cuts will basically get passed on, right? So if the idea was to give a corporate tax cut to the auto sector so that they can invest that saving that's happening, what's going to happen is most of the companies have already passed on that in the form of a price reduction to the consumer, and the consumer has still not started buying cars, right? So in terms of a longer term strategy that works, but in the short run this is not going to have any major impact. That's possibly going to be the story this year as well, in terms of how we look at the budget that's going to come. It's unlikely that the budget is going to have a magic wand and it's going to kind of change everything, but there could be some interesting parameters that the government could look at. So what do you expect the government to basically do in this particular year? Possible values. Now, the government will have to be a little bit realistic with what they are targeting. One, they will have to come up with the actual estimate of what they are going to collect. They will come up with a revised estimate at this point of time. If the revised estimate is higher, like last year, the revised estimate was given to be higher, and then it appears like a smaller. So if let's say the revised estimate is 15.5 lakh crore, then a 10% growth on that will basically appear like 17 lakh crore kind of a number. In reality, if we have 14.4 and 12% growth, we still end up at 16.25 lakh crore. So it's important to understand what is going to be the actual number, and those estimates have to come in. We anticipate about a 12% kind of a growth, and this is assuming about a 9% nominal GDP growth rate, which is approximately about 5 to 6% real growth rate and around 3 to 4% inflation. If that plays out, then our expectation is that tax collections should grow at 12%. It should stabilize, and you should see a revival. Of course, if this does not happen, then all bets are off. So that's something that has to be seen. The government will have to somehow figure out a way of increasing disinvestment. Now, the markets are not really interested in disinvestment, but the government has to somehow push it in a way that it becomes palatable. So it's likely that instead of disinvestment, we see a bigger wave of privatizations. The government will probably have to be open to the idea of selling the entire stake in a PSU rather than trying to do piecemeal 1%, 2%, 5% here or there, which honestly doesn't really add up to the demand. Nobody's really enthused about it till the time the management control doesn't change, and that remains an issue. Non-tax revenue this year has been a big jump because of the RBI dividend. Unlikely that can keep happening every year, so we've kept it constant here in our assumptions. All these would add up and give you a total receipt of about 20 lakh crore plus 1.2 lakh crore, so that's 21.5 lakh crore. Expenditure, you would expect revenue expenditure to jump by 10% because all your rural schemes come here. So it's very unlikely that you can shut all of that down. You might focus on a smaller growth rate, but it's unlikely that you can change that dramatically. Given the limited elbow room, it's also unlikely that capital expenditure will grow dramatically. It should ideally, for the sake of India's long-term growth rate, but it is unlikely that it's going to grow dramatically. So we're probably expecting a 15% growth rate there as well. If these numbers work out, then the government is likely to give a fiscal deficit target of 3.7%. This, remember, is at this point of time sort of a very conservative estimate of how things could play out. If the slowdown continues a little bit more, then I think there is going to be a real problem in keeping it under control at 3.7% or 4, below 4%, to be honest, because there is no other way in the equation of your GDP, which is G plus C plus I plus X minus M. If consumption is not growing and investment is not growing because the economic demand is not picking up and exports minus imports cannot change, then for the GDP to grow, the government has to spend. So either of these things can happen. If the government doesn't spend, then the GDP doesn't grow. If the GDP doesn't grow, then automatically the tax collections also go down, right? So I don't think the government has a way out of this other than saying that we are going to spend, we have to spend, right? Of course, they can focus on certain sectors, but those broadly look likely numbers. We are possibly going to see about a 3.7% kind of a reading as an announcement. If they announce anything less than 3.7%, then that's probably very unrealistic. That's not going to happen, right? So that's something that you have to keep in mind. If the government comes out and says in this environment that we're going to keep fiscal deficit at 3.4%, and they are genuinely interested in doing that, then that's negative news for the capital markets, because then they are not spending and they're letting the market takes its own sort of course correction, and that's going to be a little bit of a problem, right? Tax rate adjustments, unlikely that there is going to be a change in corporate tax rate because they've already done it in September. So that's where we are. Income tax slabs may move a bit, but that may not have too much of an impact. Honestly, that's been there for a while. They did not do it in the last year when it was probably a populist possibility of having a populist budget, there is there is sort of expectation building up in the market that income tax slabs might get revised dramatically. But I can't see where is the room, honestly, that is there. The government needs to focus more on job creation rather than, tweaking these rates too much. They can tweak a little bit, but honestly, very unlikely that could have a major impact on how people do. Even when you change tax rates in a sort of a slowing economy, a lot of the times, income tax going down does not result in spending going up, but it ends up resulting in savings going up. That doesn't help. You want consumers to spend, but if the economic environment is not good, then even if you give people a tax break, it's very unlikely that they're going to go and spend it. So that may not be a very prudent step or possibility of that being useful, right? There's a capital market expectation that long-term capital gain tax on equities may be modified. Given that they've just introduced it a couple of years back, it's very unlikely they take it back. But people are expecting that they had put a threshold of 1 year for long-term capital gain tax to apply. Maybe they move it to 2 years for equities. So that's a possibility. Very unlikely that they're going to change again things too much there. Sentiment boost wise, they could do it, but in terms of that could be good for the markets if they cut capital gain tax, long-term capital gain tax on equities. But I can't see how that really changes the fiscal situation, because that number anyway is not much. So it's not going to really cut, other than sentiment, of course, that plays out. A GST cut may have a wider benefit. See, when you cut income tax slabs, as I said, in certain cases, it ends up increasing savings rather than consumer spending. But if you cut a GST rate, then what happens is the impact is actually widespread across the economy. Everyone by force kind of gets that saving and that benefit in terms of lower prices. It has a wider benefit, but given the lower GST collections, again, it remains to be seen how large a room they have to do it, right? In any case, the decision on GST rates now gets taken by the GST Council. So budget is a non-event from that perspective usually, unless they choose to announce something there, right? Other key expectations that are there: privatization of PSU entities may pick up steam, given that divestment has not found too many takers. So it's fairly likely that the government have to go and decide that, okay, let's do away with this plan of selling 4%, 5% in companies. Let's go and privatize them, or at least lose majority control in some companies and give that stake out to people who can run the business well. A lot of the sectors, the government has no real business in terms of managing those entities. There are enough private players who could take care of things, right? So that's something. In order to kind of ensure that there is a more broader growth, housing sector needs to be revived. Now they keep trying to do something around, low cost housing. The problem, however, is that urban demand of housing has to be improved or revived. So there could be, some interest rebate on home loans that could be tinkered with a little bit. Right now, 2 lakhs is the limit that comes. Maybe they increase that. There's some talk around capital gain tax removal on sale of property. That could probably trigger, sort of some movement in the real estate markets. I don't think real estate prices will go up per se because of that. They might actually go down. But if prices go down, it could actually start some transactions. And if the sort of cycle of transactions improves, then possibly the housing sector gets a boost. And that may be a possibility. In terms of, that doesn't necessarily mean real estate prices will go up anywhere in the near term, but there could be a possibility that the government tries to boost the housing sector a little bit, so that at least, economic capital starts flowing around rather than people sitting with it. So that's possible. NBFC space is likely to get more funds and funding lines in order to reduce the stress. Even now, while a lot of the NBFC measures have been taken, the credit offtake is a challenge. There are NPA issues that are cropping up, so the government might focus a little bit on that. Infrastructure may get a boost, but for that, the budget needs to be expansionary. Without that, the government will not be able to increase capital expenditure significantly, right? So that's where we are. Just a quick discussion in terms of privatization versus disinvestment. So disinvestment, what happens is, let's say government holds a stake in Coal India, right? So I think the government stake in Coal India is about 78% or 75%, something around that, right? A disinvestment will only take it down to buy 27%, so that government still holds 51%. Right? In some entities, the stake is, let's say, at 55%, in which case a disinvestment can only see a 4% sale because the government will still want to hold 51%. Now, nobody wants this 4%, right? Privatization means the stake can go below 51%, in which case the government could end up having 30%, and it becomes sort of not the major player, but a minor player. It's a strategic shareholder, but it is not a major player there. And that's the difference between privatization. I think entities would be, so Air India, when they were trying to divest stake, nobody wanted to buy because people said, boss, either you run it or let us run it. So now what they've decided is, okay, let's privatize it altogether. So that's what is the difference between privatization and disinvestment. We would probably see more privatization coming through in the coming year, right? To broadly summarize, likely fiscal deficit at about 3.7 to 4% of GDP would be supported by extra budgetary resources. Budget numbers may look achievable in comparison to revised estimates, but you have to keep a keen eye on, what is the revised estimate that the government is announcing and what is the actual number that might happen at the end of the year. Minor tax adjustments are possible, but unlikely that there's a major movement. If there is a major movement, that would be an interesting surprise to see how the government takes that. LTCG may see some amendments, long-term capital gain tax may see some amendments, and you would expect some sort of SOPs for the housing and NBFC segment, right? So that's broadly it in terms of our discussion today. Thanks a lot.